It's funny that we have a cow picture.
We are live. Hello, everyone. Jonathan Enders with the Stern team with a special guest on May 4th. May the 4th be with you, Mandy.
Amen.
We have Mandy Henrietta. She is with Wise. I'll let her do her own introduction. Tell us a little bit about yourself.
Yeah, so we're the Wise Lending team. We are powered by Arbor Financial. That's our bigger mothership. But locally here in Utah, we are focused and committed to bringing wealth through real estate to our clients with integrity, service, and education. So
nice.
Happy to be here.
Happy to have you with us today. And today's topic is about actually interest rates. Now, obviously, as realtors, we can talk about interest rates all the time.
That's like a triggering subject, Jonathan.
But we're going to have the expert talk about interest rates today instead of a realtor, someone who kind of deals with it a little bit more than us. So tell us, what's the current rate? What are the rates doing right now? I know that's been ended.
Yeah, I mean, obviously, your rate depends on a bazillion factors, right? Your credit, the type of property you're buying. People don't realize that.
Mm-hmm.
Do you know that if you buy a condo, your rate is higher on a condo?
And why is that?
It's considered a risk factor because you are sharing care of space and structure with other homeowners, right? So you don't control all the pieces. So type of property impacts, the amount of down payment impacts. And we'll talk about this in a minute because I know the big hot subject right now, right? It's been all over the news in the last week about I might as well just go not pay my bills and get worse credit because they're getting better rates. It's not really like that. And we'll talk about that in a minute. But there's all these factors that impact your interest rate. And just kind of like a rough estimate, if you are doing a conventional loan today, you're roughly 6.5 if you have a 740 credit score and 5% down. And if you're doing FHA, you're roughly 5.99 to 6%. So, and things have been hovering there for months. Like we've seen all the way down to 5.625 on an FHA loan, all the way up to 6.375. So today we are actually down a little bit and celebrating, believe it or not. Right? But what's the natural reaction to that though, right?
Yeah, especially when we were accustomed to that 3-4% rate and stuff like that. So kind of explain today, like today's rates compared to historically, how does that kind of compare historically?
So interestingly, as much as we are all feeling like rates are really high right now, we're actually roughly in the average. We're a little bit below the average if you look at the last 30 years. Even if you look at the last 10 years, rates are actually pretty solid and average right now. But, of course, we had several years with the pandemic where everybody got used to, we actually wrote some loans at 2.5% on a conventional loan. That's unheard of. In fact, I remember these days I don't promise anything because I said to a client before pandemic and rates were like 4.25. And I was like, I just don't see them getting any lower because honestly, after 30 years in this business, 4.25 is a pretty dang good rate.
That's a really good rate.
Right.
It's half what my parents had.
Right. And I literally said to this client, well, I just can't imagine they're going to go any lower than that. Well, apparently the economy went, well, here, hold our Diet Coke because we saw mid-2s at one point.
Oh, it was crazy during the pandemic time. I remember I was talking with a lead just about 2 months ago, and we were just chit-chatting to see what would take to make that next purchase and start buying a home. And she said, I'm waiting out until we get 3% interest rates. And no matter what objection I tried to handle it, she was just steadfast on that 3%. And I don't think it's going to come back unless we have another pandemic or something crazy.
Who knows? I never say never anymore, honestly. But what would have to happen? Maybe that's the question. What has to happen for us to see rates like that again?
Something big would have to happen again.
Yeah,
we would have to shut the economy down.
Right, because interest rates are used to boost economy, right? So the reason that rates came down so low is because, the country was shutting down with the pandemic. The feds were trying to keep money in motion the best that they could and to keep our economy from crashing. So they lowered interest rates so people would keep spending money, right? So what happens post-pandemic? What did that create?
Oh, just a big bubble.
not even so much that, right? The pandemic, we fed money into the system. Rates were cheap, so people were spending like crazy, and we had all this stimulus money in the market. So when there's too much money in the market, you get the opposite. You get inflation.
And is that the reason why right now they're trying to raise it just to combat it?
Right. So the best way to combat inflation is to raise rates and slow down spending. So that's what we have been in this last year. It is why we have rates have doubled in the last year. And that's a hard topic for everyone, because in relation to that, what happened to real estate? Because I had a ton of clients that when the rates were, 3.25, they said, we're going to wait for rates to go up so that the prices of houses come down, right? Jonathan, tell us what you see on your side in relation to that.
Well, the big thing that I see right now is the leads were coming in consistently, very easily. Our phones were off the hooks. Everything was going crazy. And then as soon as the rates went up a little bit, we were getting, just for easy statements, we were getting 100 phone calls a week.
Yeah.
That dropped down to 70.
Yeah.
And then it dropped down by another 50% to 35 total phone calls. So the activity of people actually going out and shopping and being active, that's what has changed.
Any ideas why?
Probably, I always blame the media, but because the media likes to throw those negative things out there.
Right.
And then it gets people stirred up. But.
Right. I joke all the time, like CNN is constant negative news, right?
Yeah.
If you want to see what's wrong in the world, turn on the news, you'll see it. So some of the things that happened, right? Like rates start climbing to combat inflation. All of our clients who said, we're going to wait for rates to rise because the values will fall. We had a little bit of a correction in the market for sure. In fact, I actually reached out to your team for some data on that, because I don't know. I don't know what the percentage of change is. And there certainly was a correction. Like, remember that we were coming from a market where people were paying $70,000 over appraised value to get into a house, right?
Without inspections or anything.
Right. And they were waiving all of their due diligence. It was bonkers. So for us, for anyone who's been in this market a long time, very honestly, we were thrilled to see this shift, because that was not a healthy market, not a great market for our buyers. Right?
It wasn't sustainable for a long term.
But everybody thought, well, rates are going to go up and the values are going to drop. And they dropped a little. They corrected a little.
Over this winter, it was, from last year at this time, it went a little bit down. And then this past few months, start of the year, it started increasing again. And that's where people are waiting to get for those rates. The unfortunate side of that is when you wait for the rate to come down, that home price,
the reverse, right?
That price of the home, you're not going to be able to buy a $300,000 home. That's going to be worth $350,000.
Right.
And to try to project that and help buyers and help people out there who are looking, it's really hard sometimes, especially when you're combating the media saying everything's crashing, the prices are slashing.
Well, and depending where you are in the country, that actually may be true. There are markets that are not thriving, right? There are markets that are not thriving. So, I have some clients who sat out, right? And then rates went up and they went, great, we're going to go out shopping. And do you know what I've heard from almost every one of them is, well, the prices didn't fall in relation to the rates rising. It was not an equal trade, right? Yeah. Rates doubled. So I reached out to the team. I was like, hey, I need some data on this just so I can understand. And I'm going to dumb it down because I'm not a real estate agent. But what it basically equated to is here in Utah, Wasatch Front-ish, taking the very highest drop, right? And then rounding it up, we maybe saw a 14% adjustment downward. And from January 1st, so that was from June of 2022 to the end of the year.
So last 6 months.
Roughly 14% drop. From January of this year to current, we have seen a 7% increase.
Prices are coming right back up for homes. And that's where if buyers are on the sidelines, they're going to be on the sidelines for a long time.
And I feel for our clients because it's an affordability issue, right? So now prices are taking off again and rates haven't improved drastically, right? It's better than it was. We actually saw the mid sevens at one point at the height. It's better than it was. The market has settled down a bit, but we're not back at 3%. So it's still an affordability challenge for people, right?
And it's also, it's affordability, and it's helping project and not in a way kind of educate. It's like, hey, you can buy this house right now at that 6% interest rate. But in 2 years, when rates maybe come back down, you refinance everything.
Because it is, I mean, we've all heard that what goes up must come down and vice versa, right? Certainly, because here's what's expected. So the expectation is that the Feds have made this shift in the market to combat inflation. In doing so, inflation's an interesting monster because it's kind of a 12-month average, right? So the Feds have doubled down on this. They're like, we've got to get, I mean, inflation was, nines, high nines. The goal is to get back into the twos, right? And that is real life issue for people outside of homeownership. It's, the price of your eggs. It's it's gas, it's all the things, right? It's living items.
I recognize it myself, just your normal basic, going to the grocery store, buying the necessities to live, your, toilet papers, your paper towels, your soaps, all that, was $20. Now it's $25, $30.
Right.
And that's across the board everywhere. So they need to get that inflation.
Yeah. I mean, you would go for your basics weekly, and you used to do it, I mean, I have teenage boys, so really it's never like this. But if I stock in for, just the really quick, eggs, milk, bread, right? I used to be able to pop in and out for $40, and now it's $65, $70, right? That is a real life issue, a survival issue for our country. So the Feds have doubled down on this, and they've been super committed to getting inflation in check.
As they should, yeah.
Right. What that is expected to create, though, is the pendulum where we then will be dealing with recession. And what do you do in a recession? You lower interest rates so that money keeps flowing again.
So then you can spike it right back up.
Right. Because now we're seeing in this moment where people are starting to not spend because they're like, oh, our credit cards have been run up. We burned through savings. We're having to go back to the basics, budgeting, right, as a country. Well, when the money stops flowing, that creates recession, and then
job loss, everything else is going to.
Right.
And then at that time, hopefully the inflation drops a little bit, and then we can get back up and going.
Right. So the expectation is that then the Feds will be faced with the decision of lowering interest rates to boost economy again, right? It's a vicious cycle.
I'll say that's a never-ending cycle. It sounds like.
It's a vicious cycle. And so no matter what your beliefs are politically, or whether you agree with it or don't agree with it, that's just an economic cycle that has happened historically, will continue to happen. It just is what it is, right? So to your point, if you understand that rates aren't the lowest they've ever been, but they're normal, they are normal right now.
It's a healthy rate.
Right. And real estate is likely to climb. I mean, Russ and I have had this conversation many times. If you look at any 10-year gap, right? If you bought real estate a year ago, right, you probably haven't made a ton of money right now, right? You might not be ahead, right? But any 10-year window that you pull historically, you're gonna make money.
You're gonna have
even if you've held it for 10 years and on year 10 the market is down, because you will have picked up all of the positive before that down. Even the down, you will be up.
Still be up.
Right.
I ran some numbers a couple weeks ago where if you bought a home in I think it was April of 2020, and compared to what it would be appreciated, how much wealth you gained, you would have actually gained over $175,000 in just 2 years.
Yeah.
But part of that was the 20% not inflation, but 20% appreciation with real estate.
Which is not normal.
No, we need that healthy 5%. Yes, it would be great for real estate industry, but it wouldn't be great for the economy. We need that healthy 5% to keep appreciation going up, people buying, selling, and everything.
Yeah. And I mean, as a parent of teenagers, right? The thought of things increasing at 12, 17, 20% a year, terrifying. Because your kid's never getting into a house at that, right?
Exactly, yeah.
It's not healthy. It's not great. It was really fun. Let's be honest. A lot of people had some big wins there, but it's not sustainable.
It's not one bit.
So the current, the current discussion and maybe education piece is, you have to recognize that rates are a cycle, right? They're a tool used by our federal government to slow things down, speed things up, all the things, right? It's a tool. Real estate in the big picture is always a win. And that's why I say 10 years, right? I typically tell a client that if they're going to buy and they're going to sell in the next 2 years, unless they're willing, or like, if you have a client who's like, well, we're going to move out of state in a year and a half. You may not want to buy unless you want to buy and hold that as an investment property.
And which will always be a good option.
Right. Because if you can hold that property for a few years, you're always going to come out ahead, right? And certainly if you hold a property for 10 years,
you're going to make a lot of money.
That is where wealth is truly built, right?
Exactly.
So based on that idea, your mortgage isn't permanent. Mortgages can be refinanced.
You get a lower
Mortgages
rate,
can be redone. They get, in fact, even when rates were, obviously everybody refinanced when they were 3%, right? But even historically, before the pandemic, nobody stayed in their mortgages more than, I think the average was 7 years, right? People who even stay in their houses for 30 years don't stay in their mortgage. So it's an important item to keep in mind, right? But we still come back to kind of the sticking point. How does everybody afford the payment while they're waiting for the cycle to shift, right? Like, how do you do that?
Well, it's difficult to kind of do and stuff right now.
Right. So we talk a lot about the tools. There are some tools for that, right? There's ways to do that. The biggest tool I think we're using these days is a temporary buy down, a 2-1 buy down.
Explain a little bit about what that is.
Yeah, it's not an adjustable rate. You know exactly the terms of your loan. Your rate is your rate. So if rates are 6% today, you lock a 6% interest rate, that is still your rate. But your first year, the seller's contributing a lump sum of money that is held in escrow by your servicing company that is supplementing your payment each month. So the first year that you're in that home, you're making a payment based on a rate that's 2% lower, right? So your payment is based on 4%. On a $450,000 house, that's $500 a month difference in payment. That is a massive.
Throughout a year, you're going to go and accumulate a full payment right there.
Right. And the full payment is still being made. Every month, your full payment is still being made. You're not negatively amortizing your loan. It's not an unknown. You don't know what your rate's going to be in 2 years. You know exactly where your payments are going, right? Which makes it safer than an adjustable rate mortgage.
So tell me, if someone does take advantage of this 2-1 buy down in 2 years, that's a great opportunity then to refinance this.
They don't even have to wait 2 years.
They don't have to wait 2 years.
They don't have to wait 2 years. This is the crazy thing. So say you're in this mortgage and you're making a payment based on the rate that's 2% lower for the first year. The second year, the rate is based on a rate that's 1% lower, and then it shifts to your total payment, right? Say 10 months from now, a year from now, rates drop substantially, and there's a really good opportunity. There's no prepayment penalty. If you refinance, that money is still sitting in an escrow as your money. The servicer will actually apply that to your principal balance and pay down your principal balance, which roughly covers the cost of your refinance.
Yep.
Right? Like, give or take, depending on how many months we're into this, it's a pretty good gig.
And I remember when I first joined the team, got into real estate, 2-1 buy down, like never heard of it. And then all of a sudden, like a year ago, it was like the best thing ever.
Those of us that have been doing this for 30 years were like, hey, remember back in the day when we did X?
Let's go back to 2008 and re-implement some of these strategies to help our clients
Absolutely. Right? Like what's old is now new.
Yep.
Right? So it's an interesting way to do things. Now, one of the big things that we then hear, right? People are like, well, then we're going to have a crash because everybody can't afford their mortgages.
Well, the foreclosures, the rates are very, very low compared to what it was in like 2008.
Absolutely.
You could see the line, foreclosures are going up, up and up and up. And then all of a sudden we hit our crash. Like right now, we are still below the 30-year
holding very steady because underwriting is different now.
Well, they got the rules and laws and regulations.
Regulations. You have to have more than a pulse to get a mortgage now. Like, make no mistake, you're going to jump through some hoops to do that. As well, we should, right? To avoid that moment.
We don't want to have happen what happened in 2008, where people who were unemployed were getting houses, moving in, and then all of a sudden the banks were having to foreclose, all that good stuff.
Right. It was not, that wasn't good for anybody. So the beautiful thing about that temporary buy down is it's not creating the same risk that an adjustable rate mortgage is creating. Clients who are using that product have to qualify at the full payment. It's not like they're qualifying on this temporary payment. They're not. You have to be able to technically qualify for that big payment. It's just that it eases some of that transition for people who, they're coming out of rent, and although rents are going up. They're increasing drastically, right?
South Salt Lake was up 20% year over year in the month of April.
But for the people that their landlords haven't increased yet, it's the first time I can remember in a bazillion years that sometimes it's cheaper to rent. But you still have nothing to show for the rent.
Well, it's cheaper to rent for a couple of years.
Until it catches up.
And then all of a sudden, when your monthly payment would have been $2,000, but your rent payment's $1,600, you're like, oh, I'm saving $400.
Right.
I'm going to be saving $4,800 in a year.
Right.
Well, yeah, you would save that $9,200 over a couple of years, but once it actually hits, you're going to be paying more than that $1,800, that $2,000. You're going to pay $2,200 for that apartment.
Right.
And
when you go to buy, the price will have gone up far more than the $9,200.
Exactly.
Right? It's a chicken and egg moment that we're in. So that's the thing that we're running into a lot too. So that 2-1 buy down helps that transition, right? Because people are for the first time in a long time, it's not, for ages we got to say, for what you're paying in rent you could actually own. Right now we're seeing a lag because leases were written previous to this inflation spike. So it's just a matter of time before landlords catch up.
Well, and they will catch up.
And they will.
They have bills to pay as well. And they're running a business. So
And I've talked to clients who their rent went up $500 in 1 year. That's a substantial shift.
That's not substantial.
To me, that would cause me such anxiety to know that I didn't have any control.
You don't have control when you rent. When you're renting, you are relying on the industry and the market.
Right.
And it's a very, very it could be a fun ride, but it's a very scary ride as well because you don't know what's going to happen.
I think it's pretty hard to build your future and your budget on that unknown, I would think.
There's no fixed cost. It's going to be a variable cost at all times.
Yeah. So anyway.
So we are kind of getting a little low on time, but you made a mention earlier about what's happening in the news with the credit stuff. Don't want our followers or viewers at a later date to be watching this without us at least talking about that a little bit. So tell us a little bit.
Okay, so here's what happened, and it's always comical to those of us who work in the industry because that change that everybody saw in the news last week about LLPAs, which stands for loan level pricing adjustments, that actually happened back in January. It's just now taking effect, but it's affected your rates and all of your products for months. Okay, so it's not new. The sky is not falling.
Okay.
But here's what happened. Fannie Mae and Freddie Mac are federally backed entities, right? They're not government entities, but they are federally backed. And their mission, if you go to their website, their mission is very clear that their agenda is to help people gain homeownership. It is not to help people get rich on real estate. It is to help people gain homeownership.
Open the door and get a home.
Right. So we've seen them make several shifts over the last couple of years, right? It used to be a second home. You could buy a second home and your rate was almost identical to a primary residence. And what did everybody do? Everybody went out and bought second homes and then they Airbnb'd them and turned them into businesses, right? Fannie Mae, Freddie Mac kind of caught that vision and went, that's not what our agenda is. That's not why we're here. It is not, we're in service to people getting into homes. So this newest phase of that line of thinking is this shift in LLPAs. Okay. And it goes back to that initial thing that we were talking about, that your rate is dependent on a number of factors: your credit score, the type of property, how much you're putting down, all those things. The shift that they have made that is hitting the news and that everybody's so worked up about is they said, if you are doing a lower down payment, right, which keep in mind, this is not, for those of you who are like, well, back in my day, well, back in our day, you could buy a house for $40,000. That is no longer the thing. I don't know the area median purchase price right now. It's got to be $450-ish.
No, and in the last quarter, so this last
Yeah.
quarter of 2023, it was 550
Okay,
for all of Utah.
515. 515. So if you had to come up with 20% down of 515, that's a lot of money.
Mm-hmm.
And if you don't have a home that has been appreciating that you are selling, that has created the nest egg for that, and you have been paying high rents, your ability to save that kind of money is limited.
Oh, it's going to be very,
right?
very
It's limited. So there are programs to help buyers get into their first home that allow for low down payments. Both Fannie Mae and Freddie Mac have options for 3% down payment on your first home. Now, what they changed is they said, you know, if you have a 760 credit score and you're a really strong client, right, and you're doing 3% down, your interest rate is better than the person who has a 680 credit score and a 3% down, right? The gap was this big. They shortened the gap. That's all they did. They shortened the gap. So the adjustment for these people who have the 680 over here, that went down just a little bit.
Mm-hmm.
The adjustment for the people who had that high credit score, it went up a little bit. Now,
so why would it go up for someone?
What they're doing is a low down payment is still a risk level,
mm-hmm.
right? So they basically they're trying to even the playing field. They're saying, you know, if you have good credit, but you're still doing a low down payment, your rate is adjusted. That's a higher risk for a lender, right? The gap used to be really big. If you had higher credit, you had a lower interest rate, right? A lower adjustment.
Mm-hmm.
If you had low credit, it was a really high adjustment. And what they were finding is that was becoming a big barrier to entry for some of these families who do not.
First-time home buyers,
they maybe don't have the depth of credit that creates those high credit scores.
Mm-hmm.
It may not even be that they don't pay their bills, right? It might be. We deal with a lot of Dave Ramsey clients here. Sometimes if you aren't participating in the credit game, you also don't have high credit scores, right? So what they did is they said, okay, it's a risk on both ends. We've always made a very small adjustment for our clients who have really high credit scores. Instead, we're going to level the playing field. If you have high credit scores and you have a low down payment, the adjustment's a little higher than it used to be. If you have a low down payment and you have lower credit scores, you're still going to get hit with an adjustment. Your rate will still be worse, right? I'm getting all these calls. They're like, well, apparently I should just stop paying my bills because I'm going to get a better rate. No. That is not the thing that happened.
Pay your bills, everyone.
Pay your bills. That didn't change. If you have good credit, you will still get a better interest rate. However, not quite as good as it would have been a couple months ago, right? They are indeed subsidizing that risk level that they're taking for the clients who have lower credit scores. They're subsidizing that with the higher credit score clients. That is absolutely happening. Yep. They took the chasm and they went from this to this.
They're trying to make it just a level playing field for people. So
they're just trying to help people get into homes.
And that's a good thing actually to be doing.
Right.
Because there's a lot of people we speak with who, hey, we have bad credit. I can't get in. I can't get that 5%, 10% down. I have bad credit. So they're working on a lot of different things.
Right. And maybe they made all of the mistakes in college and they got all, they walked by the Union building and picked up the 4 credit cards, not understanding the impact of that move,
mm-hmm.
right? And they trashed their credit and they've been working for years to rebuild it. I will tell you, the rebuilding of credit is slow. So the fact that they have a lower credit score doesn't always mean that they're a bad risk. It might just mean
they
stumbled,
period.
Right? They stumbled somewhere along the line, right? They had a medical issue that happened that destroyed their credit. Right. So all that Fannie Mae and Freddie Mac are doing is they're just saying, hey, we just want to give these people a little more of a boost. We want to help them just a little bit more
mm-hmm.
and shorten the gap between these two things. Okay. So please pay your bills.
Yes.
I hate that narrative that's out there.
But once that narrative gets going, it's really hard to stop it. And everyone sees it. You don't just see it on the news. You see it Facebook, Instagram, TikTok, Twitter, all of them.
Right.
And once it starts rolling, that's just...
And fear sells.
Mm-hmm.
Fear sells. It's why news functions in fear, right? It sells. It's what everybody tunes into.
It's that headline that gets you to click, even though the story itself is completely opposite. It tells you opposite of the title. but that headline, that's what people read 90% of the time. And they
Absolutely.
just scroll on.
Absolutely.
So I think today we've hit one thing is don't wait, because we were talking about the prices are going to be going up. And if you wait, you're going to stop.
Right.
With rentals, if you're cheaper price right now on your monthly payment, if you wait, you're going to actually end up paying for more.
But maybe look into using a 2-1 buy down, a temporary buy down to help you make that transition through that stage.
And then also with the new laws, the LLPA, right?
LLPAs.
I got it right. Yes.
Yeah.
People who waited a couple months ago, now they're suffering. So I think the moral of the message is don't wait. The best time to buy was yesterday.
Yeah. I think somebody said to me the other day, when the best time to buy was 5 years ago.
Mm-hmm.
Okay, but what if you didn't buy 5 years ago? When's the next best time to buy?
5 minutes
when
ago.
you can qualify.
Yep.
Do it. If you can qualify, if you can get into a house, make the shift.
You're just going to be better off. You're setting yourself up for success.
Right. Because then you can be like the people who bought 5 years ago who are like, oh my gosh, do you know how much money we have?
We've just made ourselves $150,000, $200,000 in equity. And now this starter home that we've completely remodeled and we can flip it, we can keep it as a rental and get into that forever.
The house, the dream home, or the neighborhood we want to raise our kids in, and all the things, right? It is a stair step. Nobody gets their dream home right up front.
Mm-hmm.
So
unless you win the lottery. So.
Right. Well, maybe.
Maybe.
Yeah, maybe.
Well, that's everything for us. If you guys ever do have questions for Mandy, you can reach out to her. We'll make sure that we put your contact information everywhere. Mandy is absolutely the best lender in the entire Wasatch Front. Yes, we're partial to you, but you are awesome.
You're nice.
I appreciate it.
We appreciate you guys.
Well, if you guys have any questions, reach out. Otherwise, we look forward to seeing you next week, Thursday.
Bye, everyone.